My name is Paul Wallace. I'm the Africa editor at The Banker magazine, and I'm here with Paul Robinson, the Chief Executive of Alquity Investment Management. Alquity focuses on socially responsible investments that factor in ESG, or environmental, social and governmental issues. Alquity also has a Pan-African fund that has a large exposure to sub-Saharan Africa. Paul, thanks very much for joining us today.
Good morning, thank you, Paul.
Firstly, just what is the demand for ESG investments in Africa today?
Well, ESG has been a rapidly growing area in investment across the globe, as you've seen from the big numbers, the UNPRI growing to now $31 trillion of assets under management. But I think it's important everywhere, but it's most important in emerging markets and frontier markets like Africa, because when you start looking at environmental, social and governance issues, if you're operating in developed markets, say in the UK, you have a lot of institutional infrastructure that protects you, a lot of laws that protect your own environmental issues, governance, social issues. In some of the more frontier markets, those institutions are in their infancy, or maybe not even present, so you really need to rely on company management and you need to know what they're doing. So as people start to understand what ESG can deliver in terms of risk reduction and understand the risks for those frontier markets, we're really seeing a strong growth in demand. If just to put that in slightly more context, I'm saying when most people invest in frontier emerging markets, a lot of their concerns are political risk and corruption. But they also know that if they invest early, they get the best returns. When you went into China, you made nearly 1,000% return between 1990 and 2000, and only 70% between 2000 and 2010. So you go in early, you make the returns, but you have a lot of risk that you worry about. And ESG is the bridge that can reduce that risk. So you can go in early, mitigate those risks and get better returns.
And just how do you approach ESG investing in Africa, and specifically Ghana, which is a country that Alquity knows well and has quite a bit of exposure to?
Yeah, so it's a question, it varies by country, it also varies by sector. If you're investing in something like extractive industries, and we're investing in Tullow Oil, who have big holdings in Ghana, you're looking at a lot of very different things than something like Ghana Commercial Bank. Ghana Commercial Bank, you'll look at corporate governance, how they structure their pay, rewards to make sure they're in line with good governance for the shareholders of the bank in the long term. Something like Tullow, you're looking at biodiversity, you're looking at how they treat the staff, health and safety standards. And you can take a lot of developed world knowledge and look at how they're operating in Africa within that environment. So Tullow is an example. There aren't a lot of carbon emission laws in Ghana, but there are in the UK, and Tullow operates in both, and it tries to apply the legislation that applies in the UK. They operate in Ghana, and hence they have a CO2 emissions of 180 tonnes of carbon per $1 million of sales, versus an industry average of 1,000 tonnes per $1 million of sales. So we look at those type of measurements to see how we use world-class standards and apply them to African companies. And then we look very hard at the trajectory of where they're going, not necessarily where they are today, but what management intention is and how they're trying to move. So again, if they're not doing very well, for example, on health and safety, do they understand that? What are they aiming for? What process do they have in place? And then we track it over time.
So it seems clear that there are plenty of opportunities for ESG investing in a country like Ghana, and it's not just small companies you're talking about, it's big ones. It's the Tullow Oils, and also you mentioned Ghana Commercial Bank, which is the biggest locally owned lender in the country.
Yeah. Well, we're a daily dealing listed fund, so we're in large cap listed stocks, but because we also have our donation element where we put 25% of our fee revenue back to fund microfinance and smaller lending in the country, we look at it from top to bottom. Our ESG works looks at what the companies are doing to put back into the environment they're operating in. So what training are they doing for local staff? Certain expertise for some of these companies, you need international expertise, but what are they doing to train up local people to be able to take those jobs? What are they doing to support the country that they're in and the local infrastructure? And let's not forget, if you go back and think what is sort of political risk, for example, when you worry about investing in these countries, political risk is the danger that the government removes your license to operate. How do you avoid that? Well, you actually engage in the country that you're operating. You don't just go there, extract resources, take all the profits overseas. You put back into that economy. You develop the local skill sets, human capital. That actually helps build the economy, improve the GDP, and for us as long-term investors, it means that we'll get better returns for clients over time.
And what sort of returns are we talking about? Is it the case that you have to, when you go into ESG investments in Africa, you have to sacrifice returns, or in your experience, is that not what happens?
It's a very good question, Paul. I mean, we get asked that a lot. Most people think, oh, if you do things in the right way, you must be giving something up. And I just think that's completely wrong. You actually will get better returns. Think about it logically. If you say, well, investing ethically, to use that word, are you going to get lower returns? Well, do you think investing unethically is likely to give you a better return? You end up with a lot of long-term problems. So if we took something, not in Ghana, but in South Africa, and look at what happened around the mines last year, and Lonmin, platinum miner in South Africa, lots of problems with their labour standards. We looked at Lonmin as a potential investment. We wouldn't invest because we weren't happy with their labour standards. The share price is down 50% or more, massively down against others in the sector because of the problems they've had from not addressing the way they deal with their workers. They had, I think, 34 people shot in South Africa.
In the Maricon incident in last year, August.
Yeah. Yes. So how can that be good business? So we're looking at it not from a moral perspective, but actually it's bad business not to look after your workers properly, not to follow decent extractive industry standards if you're working in the resources industry, if you're working in something like banking, if you don't look after your staff properly, if you have poor governance practices. It's not an African example, but look at what's happened at Barclays with the LIBOR scandal. That's destroyed shareholder value. And part of the problem there is that the pay structures for the staff weren't properly aligned with the reward structures for long-term shareholders, I would argue. And so something like Ghana Commercial Bank, we will look very carefully at how the executives are rewarded and make sure it's tied in for the long-term benefit of the shareholders so that you don't get a conflict between the two.
Paul, thanks very much for joining us.
Thank you for your time.